Welcome to the Mastermind webinar. My name is Wendell Hunter, and today we're going to be talking about the 5 steps to build your investment strategy for 2020 and beyond. I am joined with Steve Rozenberg, and he's going to go through all of everything you need to know to get prepared for 2020 so that you can make it your best year, so you can live your best life ever. Steve, I'm gonna let you take it from here.
All right, how's everyone doing today? So what we're gonna do is, let me go ahead and put this in presentation mode. I'm gonna shrink this. No? Okay. All right, so today what we're gonna talk about is the basic blueprint that you have so that you can basically get your 2020 strategy, get clear goals, and basically create your end destination. And in part of that, creating the destination, the goal is you're going to have to create the strategies to get you there. And so we're going to talk a little bit about that and why this seems to be a bit of a confusing topic for a lot of people, that they don't seem to understand the difference between a strategy and a goal. So we're going to discuss that. And my goal is to just give you a very high level outline to get you on track and on path with all those things. So what we're going to cover today, very simply, is we're going to start with a goal. We're going to have you help identify what your goal is. We're going to help you build out the strategy to get you to that goal. Then we're going to help you come up with your parameters for your buy box, meaning what is a property or an investment that fits your criteria. Then we're going to talk about the resource team, of how to have the right people on your team and understand the power of leverage of other people. And then lastly, we'll talk about your accountability partner. So we're going to kind of go through those things. Obviously, if anybody has questions, please put them in the question box. And what we'll do is, when we're done, we will go ahead and answer the questions, or you can ask me live, and I'll answer as frankly and quickly as I can, depending on how many we have. So let's start with number 1, setting your goals and identifying your strategy. So the first thing you want to ask yourself, I always say, 2 questions, 2 very basic questions. And the reason I say you can keep it basic is you can really dig deep into this and get very confused and get very prolific on how you want to live your life, and you'll get off track of this main 2 questions. So the first one, very simply, is why am I investing in real estate? And that's a question that a lot of people, they really don't have an answer for. And you may not have an answer right away, but this is something that you want to think about to see, is real estate even something that you want to get into? And if so, why do you want to get into real estate? You basically need to come up with an explanation as to why. Just because other people did it, just because you had an uncle or someone that did it, may not necessarily mean that you will like it, and this will be something that matches who you are and how you think of things. The next thing I would say is you want to ask yourself, what do you want your life to look like, an end result, because of owning real estate? And again, this is something that a lot of people I talk to, and especially if you're married or have a spouse or significant other or children, these are things that you really want to have a group conversation on. And you really want to bring the whole family and business partners or whomever, and make sure that you're aligned. Because let's say you have a spouse and you're thinking, I'm going to be a powerhouse and I'm going to own a bunch of properties, commercial, and we're going to do this and we're going to do that. And your spouse may be thinking, oh, we're going to own 1 property and that's all we're ever going to own, maybe 2 rental properties, and then we're going to just relax and catch some cash flow. So now you're going to have 2 different strategies and you're not going to be in alignment. So that alignment is very, very important when it comes to making sure that everybody is on the right goal line and they have the right strategy to get them there. So again, just something you want to ask yourself is, why are you even doing this? Why do you think real estate is that vehicle? And what do you want your life to look like as a result? What does that picture look like? Like when you retire and you reach your goal, try to really identify that. And again, write this down, bring everyone in your immediate circle in, and brainstorm it, throw things against the wall and see what sticks. And you may find out that other people have different basic goals and end destinations than you may have, and these may be people that you're married to, but you never actually had that alignment conversation. And I recommend that you do alignments with a significant other or business partner once a year. It's very important because things happen. People have kids, people get married, divorced, job changes, all these things happen within a year. And what happens is maybe your alignment goes off. And so it's always a good reset to always do an alignment session at least once a year with the people that are going to be affected as a result of you being involved in real estate. So I talk about definitions a lot. And I think one thing that we as people that get involved in real estate have a hard time doing is taking the time to slow down and really understand the definitions of the words and terms that we use. A lot of times we hear these catchphrases and we hear these terms, but we don't really know what they mean, but yet we still use them. So the very basic ones are the definition of a goal and the definition of a strategy. And the reason I bring this up is when I talk to a lot of people, I'll ask them, what is your goal? What do you want to accomplish? And they'll say, well, I want to own 100 houses. Well, owning the 100 houses is not the goal. That is a strategy. That's called buy and hold. And the strategy is what you're going to do to get you to a goal. So the end destination may be what the result of having 100 houses could be. Could be a cash flow, could be the fact that you have peace of mind. And so the owning 100 houses is the strategy. And the goal is the destination. And a lot of us confuse those two. We may think flipping, wholesaling, buy and hold, owning notes, all these things they think are end goals, and they're not. It's like saying that I'm going to get on the freeway and that's my goal. That's where I'm going. Well, the freeway is just taking you to a destination, but you really, really want to clearly identify and understand that end destination that you're going to, and then the freeways that are going to get you there are the strategy. And the strategies could be buy and hold, like I said, flipping, wholesaling, whatever works for you as part of your strategy. I'm a big believer in buy and hold long-term investments. I'll explain why in a little bit. Not that one is right over the other, it's just a different strategy. And depending on what your immediate needs are and what your end destination is, because everyone's different, that's how you want to make sure that you set this up correctly. So again, you're going to hear me pound on this a lot, the goal setting. And the reason just a personal thing is the reason I'm so eminent, or whatever the word is, but the reason I'm so wanting people to understand the goal is when I first started investing, I never had a goal. And what I was doing, my challenge was I was just buying investment properties because I thought they were good deals, because they had great cash on cash return or my return on investment. And to me, everything that had a high return number was a good deal, and I bought it. The problem is none of those properties took me to my end goal. First reason was I never had an end goal. Secondly, they actually took me further away from what I thought my end goal was. I wanted passive income that were just going to give me a return on my investment. The reality is the types of properties that I owned, while they weren't bad properties, they were bad for me, because that strategy of a low income pricing and having properties that had high turnover was not the types of properties that I wanted, and it actually took me further from my goal. And if somebody would have ever asked me, Steve, why are you buying these properties? And if I would have explained, well, I want passive income, I want properties that go up in value, I don't really want headaches, I've got a job as an airline pilot, this and that, they would have said, well, these properties are not going to get you there. As a matter of fact, they're going to take you further away. And if somebody would have told me that, I probably would have saved a lot of sleepless nights. I would have saved a lot of money that I lost getting rid of those properties, and just quite frankly, a horrible experience. Although I learned a lot from it, it was not something that I wish anybody to go through if you could avoid it. So having that end destination, that goal, that North Star of where you want to go is very, very important. And understand that this goal can change over time. Your life circumstances can change, maybe the environment where you live, all these things can change. But as long as you're cognizant of understanding you need a goal, it's very, very important to always keep that front and center with why you're doing it. And if you can say, this is getting me closer to my goal by purchasing this property, selling this property, doing this or doing that, thinking about that will at least make you think to make more strategic decisions than reactionary decisions based on what someone else told you or what you think is the right thing to do. So the next thing is building out your strategy. And again, this is where you really have to understand and be honest with yourself as to where you are today. So this goal is for 2020. And so what you want to think about when you're thinking of your 2020 goals is, what is the strategy to get me to the end of the 2020 goal? And so you kind of think like, okay, maybe you need cash flow right away. Maybe you don't make enough money and you say, I need to get some capital to start investing. Well, then that may make sense that maybe you do something where maybe you flip a property, get some cash in your pocket so that you can go and buy an investment property. Or you may say, you know what, I don't have the time, I've got a career, I just want to get in and start buying properties to start planting the seeds for wealth. Then that is something that if you say, if I don't have the time, then that may not be something that I do. So when you're thinking of buying properties as investments, I think that there's 5 pillars and 5 things that you should think about when you are coming up with the reasons to buy or not buy. And remember this, when you look at a piece of property, it is purely a mathematical equation. There is no emotions at all that comes in to buying a property. Sometimes where we make the mistake is because we live in a property, we equate that same thing to owning a property that you have for rent. And these are completely polar opposite. This is a business, and part of that business is the fact that it purely runs on numbers and mathematics. So when you are looking at a property, it should be pure numbers and nothing to do with emotions. So the first thing you have is you have the cash flow. And the cash flow is how much money you're going to make of the rent minus your debt servicing and insurance and all the other things. And the difference between the two is the cash flow. Most investors feel that that is the most important thing to them, is getting the most cash flow. However, when you dig deeper, it's really not the biggest reason that you should or should not buy a property. It's a piece of the puzzle. It's a reason to or not to as part of a bigger picture, but it is not the only reason. And I'm going to explain a little bit as to why. The next reason could be equity capture. You may be in a market that is a very hot market and it's hard to get deals, and the ability for you to get equity capture on a property, meaning the property is worth X and you're getting it for X minus a certain percentage. So let's just say a property is worth 200,000 and you say, well, I want to get it for 160,000. Okay, well, that's a percentage. So again, I think it's important that when you're talking numbers with properties, you don't talk figures, you talk percentages. I want a property that I'm going to get a 10% equity capture, because that number could slide either way. And so that can become one of your parameters that you say, okay, equity percentage of X dollars is something that I would like to have in my investment strategy. Next thing is you have the debt pay down. Now, let's say you get a mortgage of $160,000. That means that that tenant who rents that property, let's say your buy and hold strategy is 30 years. So from year 0 to year 30, in a perfect world, you're going to have it rented for the majority of that time. And during that time, the tenant is going to be paying the rent, and the tenant rent payments are going to go towards paying down the debt servicing, which is going to make your mortgage worth 0. So you will owe nothing on the property in theory after 30 years. And that's debt pay down, which is going to happen no matter what. So that's not necessarily a parameter as part of your strategy, because that is going to happen. The next is depreciation. Depreciation is the government allows you to depreciate a property. Now, I'm not an accountant. I'm not trying to give financial advice. However, you are afforded certain deductions and able to depreciate a property. The standard in the US is 27.5 years, that the government says after 27.5 years, if you did a straight line depreciation, that property will now be worth 0 in their eyes, which that is what's called ghost phantom cash flow. And then you're able to offset that maybe with your W-2 job or other things to help you bring down your taxable income in a tax bracket possibly. And again, that's something you want to discuss and strategize with a CPA. The next thing would be appreciation. So appreciation is very, very important, and it's very important to understand the value of appreciation. Statistically, on the East Coast and West Coast of the United States, properties will double in value every 7 to 9 years. In the Midwest, it's every 12 to 14 years. Now, the thing that you want to realize and understand is that it's not a straight line doubling, because the property, as I said, the structure is depreciating, but you don't depreciate the land value. So if you had a property worth, let's just easy math for me, let's say it is $150,000 and you were going to hold it for 30 years. Now in year 15, it's going to be worth 300,000. And then on year 30, it's going to double again to year 600,000 on year 30. Now, if you looked at history of recording rental properties and investments, and properties in general, that is historical data that anybody can look up, and they can find that that is the historical numbers of real estate. You're going to have dips. You're going to, if you happen to sell during the recession of 2008, 2009, obviously your numbers are going to vary. But in general, those are your numbers. And so what you want to realize is that appreciation will always outpace cash flow. So when I talk to someone and they tell me that, hey, I want to own a property and I want to have the peace of mind in 30 years to have that cash flow, I tell them, well, okay, the properties are going to go up in value. We all agree. Whether we may have a disagreement on the amount, but we all know it's going to be worth more. If you looked back 30 years ago at where you grew up and said, if I would have bought 10 houses, wherever it is, you would be worth more money, have more wealth today just by owning 10 properties that you bought 30 years ago in any city, USA. So if you're telling me that it's important to have these for down the road, why would you worry about cash flow today? Because what it's doing today, the challenge that we all have as investors is we look at the strategies for the future, but we base our decisions on numbers that are today. So let's say you're looking at a property that's only $100 a month cash flow. Well, if it's only $100 a month cash flow today, and people will tell me that's not a good deal, my first question is, well, do you really need the money? Most of the time, the answer is no, because if you did, you probably need a job. You shouldn't be buying an investment property. But if you don't need the money, and that's not something that you need right away, then look at the long term. If you say, I want to have this down the road, well, think about it this way. As the property starts going up in value, 200,000, 220, 250, 300, 400, the rents go up also. So now you have the debt going down, the tenant is paying down the debt, and the values are going up, but so is the rent amount. Your mortgage isn't going up, taxes, insurance are going to go up a little bit, but now your spread is getting bigger. So let's say now on year 30, you have a house, let's just say is worth $500,000. Let's say the rent is $4,000 a month. You owe zero on it. So the property that people told me was a bad deal at $100 a month cash flow for today, they weren't looking about when they actually wanted it for the future and what it will give you in the future. So it's just something to think about. I know we're just talking about a one-year strategy, but this one-year strategy is leading you towards an ultimate goal. And that's why it's so important to really think about the bigger picture and not get caught up in words like the cash flow, because everybody wants to brag about how much their cash flow properties are, because that's what I did at first. And that was a big mistake. And I wish somebody would have actually helped me, like I'm trying to help you, to understand that that is not always the best strategy. So what I recommend here is decide what is the most important thing. You may say, I want a property that goes up in value 5% a year, or I want a property that goes up, that I can get 10% equity capture. And those are your parameters. So those are your non-negotiables. So to me, when I'm looking at a property, I know exactly, I want a property that's going to give me 10% appreciation. I want a property that's going to give me an equity capture of 12%. And I want a cash flow of, $300 a month. Well, those are your parameters. So then when you're looking at a deal, it's very simple to go, this property does not match my strategy. You either, one, have to change your goal because now you're changing course, or you don't buy the deal. And this is better than just saying emotionally, hey, what do you think? Is this a good deal? Well, I don't know. I don't know where you're going with this. I don't know where your goal is. So I don't know if this strategy is right for your goal. And see, now what you're doing is you're looking at this more systematically and mathematical and not emotionally. So again, remember, your investment property is a business. You've got to understand that you have policies, procedures, structure, and you've got to make sure that you are treating it like a business. And you always have to make sure that this is non-emotional. You have the IRS, fair housing, property code, tenant protection rights. All these people are basically making sure that you are running it like a business. You are documenting everything. You are looking out for all people involved in the transaction. You are not commingling funds. All these things are so, so important when you have a rental property. It's not just a house that you live in that now you're renting out. You are running a business and you need to think of it that way. So establishing your buy box, and obviously I talked about this a little bit, but making sure that you have a clear understanding of what you will and will not accept as a deal. And again, it's math. It should be nothing to do with what your perception is of a good area or a bad area, or whether you're even investing locally or you're investing out of state or even out of country. Again, you want to establish what are your parameters and what is a green light go and what is a red light stop. And you want to make sure that you're clear, and whoever's on your team is clear as well, that you have these parameters, they know the parameters, and it's very simply mathematics. Then once you know what you will and will not take action on, you can now have speed of action. Because again, in areas where there is a hot market and these are good deals, they don't last long. So if they're not going to last long, you've got to ask yourself, how can I get a deal? Well, you get a deal by speed of action. When you know exactly what you're looking for, when you're very clearly defining what is a deal, now you can take immediate action and you can buy that property, because you don't have to wonder and ask 5 different people their opinion. You get 5 different answers and nobody knows, because nobody knows what your strategy is. So I keep going back to this. You're going to hear me talking about this a lot, because I think it's very, very important, and it'll help you to get deals, because you will clearly understand what is and what is not a good deal. Next is building your team. You know, you have to ask yourself, who is your team of advisors? You know, it's kind of like, I get a lot of people that they don't have a team, and a lot of us feel that owning real estate is a singular sport. And the truth of the matter is it's actually not. It's further from that. I don't know of any investment book or real estate success story or any type of person that is successful that told me the only reason I was successful is because I did it on my own. I didn't have a team. That just does not exist. The key to having a team is that you're leveraging other people's strengths. They're getting paid in exchange for you are getting the freedom of your time. The one thing I think us as entrepreneurs and investors do not understand the value of, and I'm guilty of this as well sometimes, is understanding the value of our time and where we're best suited to do things. So obviously, being in a property management industry, I have learned that you can find a great deal. You can put as many offers as you want out there. At some point, you will get someone desperate enough to give you a property that your numbers say you're going to have a 40% cash on cash return on your numbers. That's a great deal. However, if you don't have the processes and procedures and people in place to actually execute that deal and make it happen day after day, month after month, week after year, you can have a great deal and still go bankrupt. I know many people that have lost a lot of money because they have bought great deals, but they had no idea how to run it, and they did not want to take the time to ask team to strategize on how to most effectively be successful. So again, I think asking for help and getting people to help you and getting people on your team is actually not a sign of weakness. I think it's an actual sign of intelligence, and it's showing that, hey, I value my time, and I'm going to make sure that my time is best used doing what I want to do, which could be spending time with your family, spending time on your career, or just doing something other than something you're not good at. You know, I used to always find it interesting that when I would talk to people, they chose the hardest part of owning real estate. That was the part they want to do it themselves, which was managing the asset. And I could never understand why the most time critical, process driven thing that I've ever seen in my life, that is something that they want to take on, which they can do, but you got to take the time to educate yourself, and you got to take the time to make sure you know what you're doing. Just because you own the property, you own 4 walls and a roof. There is a business running inside of those 4 walls and a roof. And if you don't understand the business, either take the time to learn it, first of all, or sub it out and find someone that can do it. But don't just get into it on your own and say you're going to figure it out on your own. That's kind of like saying, I have a tooth, I need to pull my tooth. I think I'll try it on my own, and if that doesn't work, maybe I'll hire a dentist at that point. It's kind of like, you know, I used to say it's like building a plane in the air as you're flying it. It's not going to work. And again, this is the second largest investment of your life, owning an investment property. Why would you leave that part of getting the actual money back into your bank account to the most weakest link, which could be you? Just because you own the property doesn't mean that you should run the business. 2 different things. Unless you take the time to educate yourself, learn the laws, learn the regulations, have processes, have procedures, be able to give good customer service to the client, which is the tenant, and make sure that they become a repeat client, meaning they renew their lease, because then you are able to get your returns higher. So again, it's just something to think about, that when you do have a team, best thing I would suggest is sit down and have an expectation meeting with anyone you do business with. So if it's a property management company or a contractor or a vendor, I would be very clear to say, hey, this is what you can expect of me. These are the things that I will do. This is my goal. Here's my strategy for buying properties. This is what I'm thinking I want to accomplish. Are you someone that can be on my team, or does this not match you? So for example, in the property management world, I would want to know if I have properties that are renting for $2,000 a month, but this company only manages properties that are $500 a month, they may not be aligned with my goal, right? So you want to think about that, and you want to make sure that you set those expectations in the beginning, because normally it's a lack of communication that causes problems and friction. Again, same thing with the tenant. I would be very clear with the tenant. I'm running a business. This is when, let's review the lease. This is when rent's due. This is what happens when it's late. And this is where it's going to go on the path. And once you set those expectations, a lot of times people, when they're new landlords, they try to be friends with their tenants, and they friend them on Facebook, and everything's going to be okay. We'll figure it out. Well, that happens until they don't pay. Now you're upset because you feel like you've been taken advantage of, and now you're making an emotional decision in a business matter. If you are clear up front and you set those expectations with the tenant and you're very clear, you can basically help avoid a lot of stressful time, headache, misconceptions by setting that. And remember, it's a business, it is not emotions. The last thing we're going to talk about is the accountability partner. It is so important that just because you own the business, because you own the house, that you need to be accountable. You have to set daily tasks and things that you have to do. And I tell people all the time, just because you own the property or you own the business does not mean that you are not accountable. As a matter of fact, you're more accountable because you have other people relying on you for your success. So, again, some things you want to do is set a daily task list. I think it is incumbent upon all of us to be accountable to someone, because if you're accountable to no one, you're never going to get anything done because you don't have to answer to anyone. But that is actually could be the biggest detriment to your success. So I recommend, if you can, whether it's a spouse or a business partner or a friend, someone who's along the line of you, you get a mastermind group together, you want to ask them, hey, I need someone to hold me accountable, and I'll hold you accountable. But just having someone that you have to answer to, when we had our business prior, we had board of directors meetings. We'd have to answer to the board of directors, and we'd have to come in with our reports, our KPIs. And if those KPIs, those metrics were not in the green, we had to explain why. And so it's a big difference. Just because you own the company and you own the rental property, you really want to think about those things. So, having an accountability partner is very, very important, and it actually will push you to your success, because, excuse me, it'll actually make you get uncomfortable. The more uncomfortable you can get, the more successful you'll be. If you're in your comfort zone all the time, that means you're not pushing your mental limit, and that means that you're probably not growing. And if you're not growing, you're shrinking, because you never stay the same. So I recommend, again, some kind of accountability partner, even if it's to yourself, that at the end of the day, you write down your task list, your to-dos, you mark them off. Everyone that's successful that I've ever met always has a accountability partner or some kind of success system to make sure they're getting stuff done. So we're going to take questions in a little bit, and hopefully this was helpful. I know I've pushed through a lot of stuff, and we're going to kind of dig deeper into future webinars, but just things that we covered, again, just to recap, is start with your goal. Always have a goal, and always make sure that you are always, that is the North Star that you're always facing, that you're always thinking about in the back of your mind. Okay, I can't stress enough having that goal, and the reason is I didn't have one when I started investing. And it was like a boat in the ocean with no rudder. Anytime the wind moved a different direction and I saw a deal, I went for it. And I basically had a lot of momentum, and I'd made zero progress. As a matter of fact, I went backwards and sideways, and it's just not a good place to be in. So having that goal, having that destination is very important. And next, building out the strategy to get you to that goal is also important. And again, utilize other people, get input, let them know. Don't be afraid to tell people what your goals are, and have them help you with your strategy. This isn't something where you should have to do it on your own. I think you use experts and advice and get help, and we're going to show you in a minute how you can do that. But you want to utilize other people's resources that have done this. Why reinvent the wheel and figure it out on your own? If someone's ran a marathon, I want to get trained by that person. I don't want to have to figure out how to run on my own. Next is establishing your buy box. Establish what are the parameters, and we talked about before, cash flow, equity capture, depreciation, appreciation. Establish what those are and put some numbers next to them, so that when you're looking at a deal, it's just a matter of, does it fit or does it not fit? There's no subjective, maybe we should, maybe we shouldn't. Next would be building your team of resources. Having the people around you, and I look at it as I want as many people on my side of the table giving me advice than having people run around and me try to figure out the best way and best tactics. So having that team on your side of the table, giving you advice in your best interest to get you on strategy, to get you to your goal. And you see, these are all sequentially helping you in one direction is very, very important. And lastly, you want to make sure that you identify an accountability partner. Get someone that holds you accountable. I don't care if it's your sister, your mom, your brother, your spouse, it doesn't matter, your children. Have someone accountable and again, hold them accountable. That's, everybody wants to be held accountable. They just sometimes are afraid to ask for it. So those are the 5 parameters. And if you want to know more and you want to actually talk to us, you can follow up with an email. If you want a one-on-one strategy, my thing is always, I don't need to manage someone's properties to give them advice. And if I can help someone, I wish people would have helped me more because it would have saved me a lot of money, a lot of time, and a lot of stress. I would say that you should at least find out, what are you doing right? What are you doing wrong? What are some things you need to 10X on? What are some things that you need to take out of your life and take out of that? So that's what we're trying to do, is do these wealth building strategies so that you can go ahead and figure out ways to be more successful. And lastly, we have created a mastermind real estate investment club. It's on Facebook. I do stress that you should join because we are going to be doing things in that Facebook group that we are not going to make public, only in the Facebook group. Webinars, we're going to have hot properties that we're going to be getting from our partner Investimate on deals that are fantastic deals, not only in your area, but all over the country. And these are things that are only going to be inside of the Facebook group. So again, the Mastermind Real Estate Investment Club, go there, it's free to join. It's just like-minded investors from all over the world, really, that are on this, having conversations. And if you have a question on, hey, does anybody know how to void a lease? Or what do you do if I have a emotional support animal? This is where you can ask those questions and get real live answers by people that are in the heat of battle doing it. There's no selling in the group. We don't want anyone promoting anything. We just want investors to talk to fellow investors and help each other out, because again, there's not many of us if you look at us in the world of real estate investors. So for us to be in one place and helping each other is part of our culture here at Mind, and that's what we're trying to promote. So last, we're going to take some questions. Wendell, if you have a couple.
Yeah, I'm looking, and I want you guys all, now's a good time to put all your questions in the chat. So if you guys have any questions, please feel free to put them in the chat. We have a few coming in that I'm going to address. Okay. All right, Steve, I know you talked about building your buy box and stuff like that, but for me, it just seems like if I'm someone that's trying to grow, I'm trying to grow my cash flow and I want to increase the amount of money I have in my household, it just seems like a no-brainer to go with a cash flow generating property versus, 30 years from now. That just seems so far-fetched to have such a deferred gratification.
It is, but the thing you have to remember is real estate is a delayed gratification business. It's like a slug. When you look at stocks, that's very quick, right? But real estate, that is not the true essence of owning real estate. Is you're building wealth over time. You're not building it over days. You're building it over years. And so I tell people, it's not that having cash flow is bad. You just have to understand that if you're getting a property that is a high cash flow property, you're not going to get all the things. You're not going to get a high cash flow property that's in a great area, that's appreciating over time. You're not going to get all of those things to align all the time. You may get one or two every now and then, but you have to say, okay, if I'm getting a property that's high cash flow, statistically, you may be looking at a property that maybe is a lower price point property, right? So with a lower price point property comes more time intensive work, because the clientele in the lower end property realm in general is higher turnover. They have more challenges and it's just more time intensive. I give you an example. At a business prior, we did a time study, and properties where the average rent was about $1,500 a month, so the city average was that. And we did a study, and any property that was below $1,000 a month, we did a time study for 1 year. And those properties that were below $1,000 a month were double the staff hours than properties that were above. So it's just more time. So you got to ask yourself, are you willing to trade your time for the cash flow? And if the answer is yes, then it's fine. My problem was I thought I would have passive income with these high cash flow properties, and that just didn't happen. So I had the wrong strategy I didn't have a goal, but for what I thought my goal was, I never created the right strategy. So I tell people, it's not that those properties that, I had a bunch of low income properties. It's not that those were bad. They were just bad for me because I had the wrong strategy wrapped around that. And so that's why.
All right. So starting out, would you focus on a fixer or a turnkey?
I think it depends on, number one, I'll go back to, it depends on your goal.
Okay.
So it depends on the end destination. It depends on what is your, do you know how to fix up a property?
Right.
If you say, I don't even know how to swing a hammer, then I would say probably not the best strategy for you. If you say,
but isn't it that you could probably find more upside potentially in a fixer? More of a diamond in the rough?
You could, but you could also find a lot more problems. Like when you and I were walking a property yesterday, all of a sudden you open up a wall and there's asbestos in there, and all of a sudden you're going, wow, all of my profit just went away as soon as I opened up this wall. Right. And I know nothing about asbestos. I don't want to learn. So for me, investing in real estate does not mean I need a second job. So a lot of times people think like, I'm going to get a fixer-upper. Well, all you did is you just bought another job because you're trading your time of now you're focusing how many hours and time are you focusing on working on this property to get it rent ready? And you go, okay, could I use my time better somewhere else? Is it my ego to say that I did this by my hands and I made this and I fixed this? And if it is, there's nothing wrong with that, but you're trading your time for doing something. Now, if you said, hey, I want to start a construction company and this is where I'm going, I would say different story. But if you say, no, I have no desire to do this, I would say, well, then why? Like, owning a property management company, I don't want to learn about accounting. I don't want to go ahead and do that. I got to know about it, the generalities of it, but I don't want to all of a sudden get in there and understand the down and dirty. So again, I'm not saying it's bad. You would just have to say, number one, is this part of your goal? Right. Is this part of your strategy? And is this the best use of your time?
Right. I keep hearing everybody talking about house hacking. Is that something that's reasonable with a family?
I think it's a way that, I think house hacking came about because a lot of people are in areas that is just very, very expensive to own. And if you're in an area that is very expensive to own, it's hard to be able to buy a rental property and you've got to figure things out. And I think house hacking is probably a catchphrase. It's a term that probably is fancy now. And I think, people have been doing these kinds of things forever. It just has a fancy term attached to it now. And again, sometimes you've got to do things that you wouldn't do in the future. I was buying properties that I probably would not look at buying now. I was doing things before that I wouldn't do now. Right. I don't think there's a wrong way as long as it's strategically planned out and you have a reason for doing it. Like if you sat down and said, Steve, this is what I'm doing. This is the reason I'm doing it. This is what I want as a result of doing this. And this is the next step after. And if all of that, and if I said, does all this align with where you want to go in your life? And you said, yes, this is why. I would say, well, then do it. But if you said, I don't know, I just want to do it, I would say, well, then that's not a good enough reason. So again, you've got to be able to explain it to someone that the whatever strategy of your house hacking, whatever you want to do. And that's the biggest thing. We just, and I was guilty of this as well, where I would just ready, shoot, aim, and all of a sudden I would jump in and next thing you know, I own these houses and, and it was like, why did I buy that? I was like, well, the guy selling it told me it was a good deal. Why wouldn't I buy it? Right? Well, that was the wrong way to go about it, but yeah.
All right, we have a question coming in from Susan. I live in California. I currently rent, but I have a good job. Does it make sense to purchase investment property before buying a home?
I don't think there's a right or wrong way to do it. I think you definitely can. If you have the ability to do that, absolutely. I think it kind of depends on what you're doing and what you're going to do as a result of that. So there's a lot of ways that you can strategize to do that. And look, I know a lot of millennials, statistically, more of them own real estate as investments and not as residents. So, you may live in it. Let's say you live here in the Bay Area, right? It may not make financial sense for you to buy a house to live in. It's cheaper for you to rent. Then you can go buy an investment property in Texas or some other area, get cash flow coming in from that, and that supports your lifestyle. Right. So I don't think there's a wrong way to do it. Again, I would just sit there and say, and again, I keep harping on this, I would go back and say, does this match my goal? Is this getting me closer to where I want to do it? Doing it just to do it is not the answer. Right. And so again, that's where you got to answer to someone and say, what is the reason?
So we're gonna take two more questions. Okay, coming from Bob. Steve, what markets do you like today? Which ones would you suggest I focused on?
Well, that's a good question. I think every market is good depending on the situation. There's some parameters in certain areas or states. California's about to pass rent control. That to me is a variable, it's a challenge that is not prevalent in other areas. It's not good, it's not bad, but it's just something you got to think about. You want to look at areas, number one, that are very landlord friendly states, in my opinion, that not to say that you can dominate because because the tenant is a client and you got to treat them as such. But again, I know California is a very pro tenant state, which makes it hard for you to make, you and I talked about this yesterday, where again, you're running a business. That business at the end of the day has to be making some form of profit, whether it's delayed profit and appreciation or cash flow profit, your ROI. You really want to think about, okay, am I buying somewhere that's a problem, number one, in the state? And number two, you're asking yourself, okay, where's the best return? And then the next thing I would look at is, okay, our businesses, is this a growing or contracting area because of business? So like, obviously I live in Texas, so I'm very pro Texas because number one, it's the largest inbound population growth of any other state. There's no state income tax. There's a lot of businesses there. It's a very pro-business friendly state. So you have a lot of businesses going in there, which means there's a lot of job growth. Houston itself is the largest transient city in the country. And what that means is that because of the oil industry and the expats, there's people moving in and out of Houston all the time, but higher level rents, not low level. So, you get a lot of execs and CEOs moving in and out, which means you can have a nice rental property that you can make the cash flow on that is going to be taken care of, and it is a high rental market. So again, I look at drivers, meaning I don't like areas that have just one industry. So, if I'm buying in a town that just has military or just has one company or one type of industry and everything is relying upon that, I don't like that. I would rather have something that has a lot of different drivers, whether it's tourism, whatever the case may be, commodities, things that are able to, if one goes down, the other one doesn't. Now, you can have a meltdown, I get it. But, what's interesting is, even in places that there's a meltdown, when the recession happened, rents really didn't change because all those people that lost their houses, they became renters.
Right. And
that actually drives up the price of rentals because of the fact that now there's more people looking to rent. So again, I think you have to look at the parameters. The investment software is awesome for that because I like it because it gives me all that information I want to know because I look to see, does this align with my goals? And again, I would just look at areas that are very pro landlord and very expanding, not contracting.
Interesting. When I think about real estate, it's one thing to be it's a certain kind of peace of mind that you get from actually being able to drive and see it, check on it yourself. But I can see just out of state, not being able to do that. Is there, if someone was evaluating a deal out of state, is there any like one or two key things that you would look at to just provide them comfort? Is it the neighborhood? Is it, I know you talked about job growth, but
sure,
it's out of state. I can't touch it. What are the one or two things that I should focus on to give me comfort that this is a market I should go into?
Okay, that's a great question because there's a lot, obviously in Texas, 50 to 60% of the people that own real estate in Texas do not live there. So they're mostly West Coast people or out of country people. So you got to ask yourself, why is it they're comfortable doing it and I'm not? Because I don't even want to go out of the city, right? And so number one, it's tough because it's two-dimensional, right? You're not there physically. And again, this goes back to the challenge that everybody has because they think that because they live in a house that I should be able to see that house and touch that house. And my challenge to people that say that is if you own stock in a company, you don't just buy stock in the company that's in your neighborhood, right. You buy it anywhere in the country based on the numbers. But a stock is an investment asset vehicle to make you money for your retirement, 401k, all that stuff. Real estate is the same thing. It's just a vehicle. But because we live in that house, we think it's something we have to do. And I tell people, if you own Chase stock, you don't go to the building of Chase and touch the building and kind of stick your head into the board of directors meetings. You don't do that. You buy it based on data, based on parameters, based on returns. So with that being said, I would say, number one, make sure that it will help you get closer to your goal. First of all, are we even in the ballpark of where I want to go in life and the destination? will the properties here, the strategy of these properties help get me there? And then the most important thing is getting that team in place, setting the time up to have the conversations with the property management company, with the realtor, making sure that everybody is aligned, telling them, this is my goals, these are my strategies. See, a lot of times, a lot of people that go and want to invest out of state, they don't want to tell the people they're hiring, they don't want to tell them what their goals are. It's like they want to keep it in. Well, how would I know how to help you if I don't know where you want to go? Right. So I can't help you get a good property because I don't know what your goal is. So again, it's one of those things. I mean, there's obviously a trust but verify factor. You know, when you're looking at companies now in social media, I would look them up online. I would see what people are saying about them. I would talk to at least 3 or 4 of their clients. I would want to know what's the good, what's the bad. I would want to, if I'm living in California, I would want to talk to California owners. Do you work with out-of-state investors? Yeah, we have a lot of them. Okay, I want 3 of them. I want to talk to them. Right. And then I would ask those people, what are the challenges? You know, what are things that you wish they did better or worse? And understand there's no perfect answer. You know, a lot of people think that just because you buy an investment property and you hand it over to a management company, you can walk away and not have to deal with it. And to me, that's a very ignorant thing to do, to be blunt, that you have to be more involved as a owner, as a CEO of that company. The property management company and the team are just the operating system. You are still the owner and the CEO of that business, and it's your responsibility to get the data, get the information, trust but verify. And if someone is not performing on your team, meaning the property management company, the agent, the realtor, whoever, then you have to make a decision of, are they the right person in the right seat? Are they doing the right things for the team? Or do you have to remove them and do it something else? And a lot of times people think of the team and the property management company and all that, they think of that as the afterthought. They go, first I'm going to buy the property, then I'll find it. Well, that's backwards. Find the team first, use the team to help achieve the goal, not the other way around.
Right. This has been very informative. That's all the time we have for questions. Steve, do you have any closing things you want to leave the audience with?
No, I mean, we're going to be doing a lot of these webinars. You know, obviously you can go to our website. You can email wendell.hunter@mind.co. But yeah, we're going to be doing a lot of these probably once a month, I believe.
Yeah.
With different strategies. And again, join the Facebook group, because that group is going to have a lot of data and content that Wendell and I are going to be pushing out to the teams and to people, because again, you know, we're investors, we're in the mix. I mean, he and I walked a property the other day, and I gave him a tutorial of what I would and wouldn't buy and the reasons. And so again, this is as investors, for investors, we're trying to help everybody out and educate so that you make the right decisions for yourself. And that to me, that's the key of why we're doing this.
Awesome. So we're going to be sending you guys all an email with a link to the Facebook group so you guys can join. We look forward to seeing you guys all over there. Thanks for taking time out today to learn about the 5 steps to build your investment strategy for 2020 and beyond. This is Wendell and this is Steve. We'll see you guys next time.
See you guys.